Hello and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Ankit Jain, Senior Fund Manager Equity at Mirae Asset Investment Managers. Ankit, good to have you back with us.
Yeah, hi. Yeah, thank you. Yeah.
Now, let's dive right into equities. What's really driving the current market rally? And, is it more about investor sentiment or are we seeing strong fundamentals at play? What is it, do you think?
Yeah. And also, if you look into clearly, earnings growth has panned out really well. I mean, and not only now, let's say last 1 year. I mean, if you look into last 4 or 5 years, there has been quite a stark change into the earnings growth trajectory, right? I mean, if you look into pre-COVID, 10 years earnings growth were like, I mean, fiscal year 9 to 19 were like, I mean, large cap 5-6% CAGR, mid cap 8-9% CAGR. Last 5 years, that trajectory has improved to 20% plus CAGR across both the bucket. Uh, and clearly, I mean, I think a large part of it is also to do with the fact that, I mean, apart from economy doing very well, I mean, there has been significant improvement in fundamentals across different sectors. I mean, led by government policy changes, regulations, tighter compliances, consolidation, more and more digitalization. I think all of these, and coupled with obviously corporate tax rate change and all of that has led to I think, significant jump onto the earnings. And this is one side of it, though I think large cap might have performed in line with the earnings growth. So to that extent, valuation re-rating has not been that sharp in case of large cap. But at the same time, in case of mid and small cap, besides earnings growth, a large part of return has also been come by way of valuation re-rating. So actually, some part of it is justified because given the economy where we are in at this juncture, investors are of the view that maybe this higher earnings growth trajectory might continue over medium term also, not only let's say 1-2 year, but maybe as well next 5 years also. So investors are willing to pay a premium for that, right? So to that extent, yes, I mean, I think mid cap and small cap valuations has re-rated significantly in this process. But I will say that I mean, the strong market returns are not only just by way of investor sentiments, it is backed by a pretty good fundamentals, pretty good earnings growth, and that is likely to continue.
Ankit, if we look at the global markets, for example, US and Japan, we have seen some sharp correction few days ago. Do you think so? This is a start of a bear market going forward?
So, no, so actually, I mean, very difficult to say globally. Yes, one thing is for sure that things are slowing down. Even if you look into, let's say, in US, certain data points that unemployment rate has inched up a bit. Though I think inflation is coming down, but I think there are already talks of requirement of interest rate cuts to really, I mean, again, sort of stimulate demand or maybe to actually bring down the unemployment side of it. So yeah, I mean, I think that needs to be seen. But having said that, for this Japan carry trade and all, I mean, some of these things are very difficult to really, I mean, sort of predict at any given point in time. So to that extent, I think from ultra low interest rate regime in Japan for so long, even some talks of interest rate hike and all, and people clearly has used that sort of an arbitrage to basically pump in or actually, I mean, borrow a lot of money when world over interest rates has sort of gone up. And in case of interest rates and all has to jump in, then the entire reversal of that trade has to happen. But then at the same time, I mean, frankly, it is, I mean, it is something very, very difficult to predict. But as things stand today, clearly, I mean, global growth has to slow down versus, let's say, what it might have been in last, let's say, 5 to 7 years. I mean, except for the COVID. I mean, if you try to exclude, and a large part of it is to do with, I mean, very high interest rate. I mean, across world over. And that somehow needs to be corrected.
Ankit, on the flip side, could you just tell me what are the key risks to the Indian market at this point of time?
So frankly, I mean, I think domestic, most of the parameters are looking pretty solid. Fundamentally, I don't foresee that many risks which can derail a pretty strong setup out here. Risk has to be external, more external. I mean, again, global volatility. Export demand slowing down. At the margin, and um, then geopolitically also, right? I mean, globally we have been seeing politically also some bit of regime changes. I mean, across many of the countries, a lot more imposition of trade. Trade barriers. That do create inflation, right? So I think all of those things are there. Is specific to India. I think not many risks per se, but yeah, maybe you can say froth of valuation across certain pockets that has been there. So that itself, might sort of get readjusted. Besides that, frankly, given the earnings growth are being built up, I don't foresee chances of positive surprises. So see, the case has been last 2-3 years has been that, quarter after quarter, there has been, pretty good earnings delivery, as well as some bit of an earnings upgrade, after every quarter, which is quite unlike of the, let's say, pre-COVID sort of years. But now let's say quarter one earnings just gone by, it looks like, after this quarter, maybe there might be 1-2% earnings downgrade. For 25 as well as 26. Yeah, one can always say that this is an election impacted quarter and maybe some activities and all might have slowed down, but needs to be seen. Corporates commentaries and all are still very, very comfortable. I think very, very bullish in that sense, and hoping for recovery going ahead. In the second half of this year, and all monsoons has been good. Relatively good. So to that extent, maybe yeah, this might catch up, and we might still ended up at the earnings estimates what has been forecasted.
Okay, now, Ankit, moving on, when sectors start shifting, how do you tweak your strategy? Are there any emerging sectors that you're excited about, especially those showing strong growth potential at reasonable valuations?
Yeah, so for us, investment strategy typically at a sectoral level is being driven by the underlying benchmark weights of the sectors. So for us, idea always remains to build a diversified portfolio with maybe sector positioning somewhere linked to the underlying benchmark. So that has been one of the key sort of investment philosophy or maybe portfolio construction approach for us. But having said that, yes, you are absolutely right. In a growing economy like India, many newer sectors are also sort of emerging, right? If you go back during 2000s and all, right? IT and pharma, during that decade, some of those sectors has seen a very big sort of a jump up. Now in current policy backdrop, clearly with India manufacturing hub, and then try to play an even important role in global trade, global supply chain, and with right sort of an incentivization across PLI. So yes, I think point in case, let's say EMS, electronic manufacturing, then your energy transition, then you look into, let's say, maybe this entire, consumer discretionary. So I think some of these do, and then if you look into within pharma space, this entire CRO CDMO space, with even globally, let's say, Biosecure Act sort of coming in, and then with higher trade barriers, maybe India right to win further sort of goes up. So yes, some of these sectors do offer a pretty high growth potential, including logistics also, up to a certain extent, in case if in case if, let's say, manufacturing activity has to pick up, I mean, logistics as a sector also has to play its part to move goods around. So in that context, I think the sectors where we are maybe more positive on is more like consumer discretionary, pharmaceutical, healthcare, as well as banking and financial sector. So some of these still do offer I think, pretty good, reasonable margin of safety in the current markets.
Ankit, the idea to understand was how do you shift between the sectors? So is it only to do with the benchmark, or do you have any top-down approach towards the sector selection?
So, so actually, obviously, I mean, I think top-down thought process also goes in. I mean, when it comes to the sector allocation as such, but at the same time, even if, let's say, we are overweight on something, it will never be the case that if benchmark sector weight is, let's say, 10%, suppose, and we are overweight, we will be 20% in the portfolio. So if we are overweight and similarly if we are underweight, it might not be the case that we are zero, or right. So it always has to be in some sort of a range versus the sectoral benchmark weight, and then within that, yes, I mean, active stock weight can be significantly higher. That is depending on to our sort of a stock selection approach as well as the conviction, right? So to that extent, what I will say is that even if, let's say, we are, suppose, sector overweight and then want to turn underweight, it will never be the case that, I mean, such a swift change into the sectoral weightages. Yes, I mean, it might still move in a range until and unless for some specific sector underlying benchmark weights are very, very low. But for relatively larger benchmark weight frontline sectors like banking, IT, maybe pharma, and maybe some of these sectors, I mean, yes, top-down thought process clearly goes. Let's point in case at this point in time, IT and metals, we have not been so bullish because of globally, I mean, things being tough, and many of these sectors are like much more global linked. But at the same time, I mean, on bottoms up basis, there might still be enough and more idea, even if any one particular sector top-down outlook is not good. There might still be companies which might still being able to do better because of their own sort of efforts, or maybe their addressable market or their execution. So idea is always to spend much more time on the bottoms up basis.
Ankit, so stock selection remains an important part of the portfolio. Could you walk us through an example of a mid-cap company you spotted early on? And what were the key indicators that made you confident in its growth potential? Of course, you can't name the company, but at least you can give some examples or a sector-specific thing.
Sure. I mean, no, there might be many examples, but let me again pick up maybe one of my maybe favorite one. Let's take an example: two-wheeler auto. I mean, auto OEM. So see, this was the one company which was like, I mean, invested ahead in time, right? In terms of because see, I mean, in case of auto, what is the key is the product, right? I mean, at the end of the day, right? I mean, invested significantly in terms of filling their product white spaces, investing in technology, R&D side of it, and then at the same time, sector will also undergoing a significant technology transformation, shift from ICE to EV and all that, right? So because for us, it starts with one on the business selection side of it. So business selection is like, okay, two-wheeler industry over time maybe do offer maybe mid-single digit sort of a volume growth CAGR. And plus on top of that, with premiumization and all, you add value, and then maybe ultimately top line CAGR might still touch 10% sort of a CAGR, which is for us is one of the key sort of a benchmark that any business which can grow or at least to hold potential to grow in line with country nominal GDP growth or higher, I mean, is a good thing. And then ROI and all is not much of an issue in case of many of these OEM businesses, because clearly, I mean, I think they are relatively asset light in that sense, with actually negative working capital. So business selection was fitting into this. Where was the issue or disconnect versus the market is that I mean, market was sort of skeptical around their ahead of the time investment across some of these areas, future product pipeline, technology, and all that, right? Uh, and that's why their profitability were suppressed, right? I mean, because of investment ahead in time and relatively lower base. So let's say any company operating at 6-7% margin, and if they are investing 1.5-2% additional for the future capability, so then 7% will look like 5%, which is a 30% drop. And similarly, let's say any company operating at 15%, and if investing 2%, that will look like a 10% drop. So to that extent, I think, I mean, stock was looking artificially very, very expensive because the margin base itself were low, market share, I mean, was low, but then company was preparing itself while sort of investing ahead in time to actually gain in market share, and then in that process, as your scale comes up, then with leverage and over time investment also comes down, and your profitability improves. So I think, I mean, try to understand business beyond, let's say, near-term sort of numbers. I mean, which sometimes might not offer you the right sort of a picture, while understanding much more onto the management thought leadership, and then try to build forecast maybe for next 5 year. I mean, sort of a point of view that ultimately, if whatever management is trying to invest in, how it can build up in terms of the market share and profitability, and then try to take a call. So I think it was fitting in perfectly in our business selection framework, then management evaluation, management capability, thought leadership, and then ultimately the valuation on the right sort of numbers, not the artificially suppressed sort of numbers.
Okay, so this was something that you spotted early on, you say. Now, on the flip side, has there been a time when your due diligence helped you dodge a poor mid-cap investment? And what were the red flags that stood out to you?
No, so I think, yeah, I mean, there might be many cases. I mean, also, so see, I mean, one part for us, it is as important as getting it right. I mean, but to also try to filter it out, right? So for us, it is always about, I mean, some of the metrics itself do takes out, quite a lot of poor businesses, right? I mean, that is like, I mean, double-digit growth potential, then across the cycle ROI more than cost of capital. I mean, 14-15% pre-tax ROI. And then basically historical sort of a capital allocations, and then try to look into cash flow conversion, cash tax paid, and then different qualitative sort of a corporate governance framework. So typically we do try to run. So I think this sort of a process, do any which way filter out 80-90% of the 80-90% of the maybe businesses which might not be fitting into our criteria. Besides that, our idea is also to do with a lot of primary research, right? I mean, a lot of groundwork, which can again do help us take a call around maybe management thought leadership, or maybe their practices by way of doing business over time. So yeah, I mean, I think over time, particularly now in midcap, it is still not that big of an issue, because now most of the businesses has grown in size, balance sheets, and all that. But yeah, I mean, I think some of these processes which we have laid out for us for ourselves do actually help in filtering out many of the businesses as such.
Ankit, we have seen since 2021-22, we have seen number of demat account going up and large number of investors coming into markets, typically the younger generation, and mostly they are glued into more of a small and mid-cap style of investing, due to their higher returns. So do you think, so just wanted to understand what are some of the common mistakes which they make, and how could they avoid them? You speak to a lot of investors. So what can you share the real life example? What kind of mistakes they make while making their investments in specifically in the mid cap segment?
No, so see, first of all, let me tell you that over time, clearly, I think awareness and patience I mean, the sort of I mean, rather than timing the market, time to market, or let's say time in the market has sort of gone up for the investors because clearly over time, they have understand that if in a growing economy, I think this is one of the relatively better vehicle to really put in their sort of a savings. As far as your time, time horizon is good, right? And that is what has led to, this sort of a built up. But at the same time, many of them who has come after COVID and all, they have seen the one way up, right? And while in the real life markets are not like that, right? At the end of the day, no, so see, one cannot foresee, extraordinary returns for an extended period of time, right? Sometimes market do front load lot of future returns, right? And in many cases, it is also back ended. So, to that extent, really, I think some of the new investors do coming in and all with the expectation that last 4 or 5 year mid caps has delivered 30% sort of a CAGR. Clearly that is not the right expectation. And if someone is coming in now, into the mid caps with these sort of an expectation, that is even absolutely wrong. Because as I said that, at the end of the day, I think a normalized earnings growth potential, for the market or maybe for the, let's say, mid caps are maybe mid-teens, sort of a CAGR. Because even if that bakes in a lot of market share gain, consolidation, and even, let's say, government policies or maybe that additional incentive part of it. So beyond a point, I think expecting returns more than the earnings growth over a longer time horizon is basically not, is not justified. So to that extent, I think, I will say that, expectations has to be reset. And if that is going to be the case, I do still feel that, we are not bearish on the market for sure. No, overall markets is still very, very lucrative, particularly large caps, because they haven't seen any sort of evaluation re-rating. And even within mid caps also, you look into the extent of newer businesses are coming in, sort of getting listed. We were doing just one exercise last 5 years. Almost 30 new companies has got added into the midcap 150 indices. Those are completely new and across diverse set of businesses, right from logistics to fintechs to footwear to diagnostic, and all of those are like market leader in their respective subsegment. So to that extent, yes, I think space is very, very exciting, and do offer, I think, a lot of promise from the future earnings growth point of view. But I think, yeah, sometimes market do front load the sort of a return, and which might be the stage at this point in time that probably, particularly mid caps, might be running maybe 6 months, 1 year, ahead of from the valuation standpoint.
Now, since we are talking about the mid-cap funds, the Mirae Asset Midcap Fund has had a bit of a tough time underperforming its peers in 2023 and into 2024. So what do you think has been driving this, and how do you plan to get things back on track?
So you're right. I think we have completed 5 year. 5 year it has still been a pretty satisfactory. Sort of an outcome for us, and in case of particularly mid caps, I think 3-year rolling return is what at least the right sort of a number, right? And given the sort of a the run we have seen, right? And some of the businesses that got disproportionately benefited in this process, right? And market has rewarded, I think, very, very disproportionately. And some of those segments are like maybe capital goods, some part of basically infrastructure, utility, and all, and where we have been sort of an under-indexed because of let's say their last 1 decade sort of a trajectory history, and maybe many of them were sort of not I mean, not qualifying it into our sort of a top, the process. But clearly, I mean, I think we have proven wrong in a way that they have seen a pretty strong built up in the order book, as well as margin surprises, which has led to earnings upgrade and which has also led to the significant re-rating in many of these names. So, so to that extent, I think, underweight stance in some of these sectors has clearly impacted the performance over last 1.5 years or so. Plus, on top of that, we have been overweight on, let's say, chemical, consumer discretionary, and all. Some of those pockets have seen earnings downgrades. Some part of it is to do with, let's say, global inventory destocking in case of chemical and all. And consumer discretionary was like relatively softer demand here, because of very high inflation. So to that extent, I think some of these sectors has sort of an underperformed. But now, if you look into, we clearly see a sign of mean reversion as such, where I think the demand is picking up as the inflation has cooled, has been cooling off. So I think consumer discretionary demand has to pick up, which is being the case. And plus at the same time, positive surprise element in some of those industrial infra bucket, that is going away, right? Even if you look into after government doing the heavy lifting, this year again is now back to 9-10% sort of a capex growth, right? The private sector is going to see a pickup. But then, ultimately now you look into the order book accretion, the pace of that is sort of slowing down. So to that extent, we believe that some of this has to mean revert as such. And we are already started seeing some initial sign of that.
Ankit, as you clearly mentioned, a few months ago, even Mr. Gaurav Mishra was there on the interview, and he also mentioned that the defense and some of the capital goods which you have missed the rally. So can investors expect some tactical shift there?
So see, one is like, you try to, opt for a midway path, right? Some of the segments where narrative is very, very strong, and in case if you might have missed it, and if it is a large part of your benchmark and all, you go and try to do benchmark again, right? That is the one way out to take or maybe increase exposure in some of these segments. And and second way out is like, try to not do anything forcefully, and try to stick your neck out. In terms of where you are finding value, and try to keep the positioning intact. So to that extent, I think wherever we feel like, in case if some sort of a benchmarking has to be required, maybe up to 3, 4, 5% of the portfolio we might have tried to do. But then at the same time, I think the broader construct of the portfolio is still pretty much in sync with where we do see a disproportionate sort of a risk reward with reasonable margin of safety over the medium term. So to that extent, does not want to change into the maybe narrative or maybe the yeah.
Yes, Ankit, you mentioned that you're bullish on banking as a sector, and Mirae has shown strong conviction in the banking sector across your funds, even though it's weighed on performance over the past 18 months. So how do you reassure your investors in light of this?
So see, I will say that in fact this is one of the sector which has seen a very sharp improvement in its fundamentals 5-year back versus now. So if you try to scan through the entire sector, they are sitting at the best ROE of almost 14% sort of an ROE, 1.3, 1.4% sort of a ROA, which are like, almost all time high. If you exclude that artificial number during fiscal year 7 or so. And at the same time, I think balance sheets has improved significantly. Underlying credit growth is still pretty strong, double digit. So to that extent, I think, fundamentals are very, very solid. But yeah, despite of all of this, I mean, sector has not re-rated. I mean, in general, I mean, broadly, yes, there might be stock specific, which might be trading at a premium to historical average. But I think as a basket, the sector has not re-rated, which is pretty, actually perplexed. I mean, in that sense, right? I mean, and even going forward, yes, I mean, I think NIMs and all will sort of fall down. But still, I think in the economy, there is no really, I mean, sign of any sort of a big stress building up, which can derail, I mean, some of these return ratio. Yes, I mean, there might always be pockets of over leveraging, which actually regulator is timely flagging off. But then some of those things put together are not even 4-5% of the system credit. Right. So yes, I mean, I think from ultra low credit cost, that will go up a bit. But despite of that, I mean, I think profitability remains very, very strong with, I think, decent growth in the sector. Yes, I mean, certain challenges are there with respect to deposit mobilization and all that. So to that extent, I think maybe credit growth in next 1-2 quarter and all might be relatively slow. But having said that, I mean, I think as far as if country and economy has to do well, I mean, this sector has to perform well. And that too with valuations being being on your side. Yeah.
Ankit, apart from banking, which are the other sectors you think that has a growth potential over the next few years, which can beat the market, and what drives the optimism?
So besides banking, financials, we are positive on pharmaceutical, healthcare as a sector. I mean, I think clearly fundamental for the sector has improved significantly with relatively better pricing in the US market, the US generic market. Plus, on top of that, companies has invested significantly in the R&D to build up pipeline for the complex generic, which to offer relatively better cushion to the price erosion into the US market. And plus on top of that, now even besides US, also lot many emerging markets are also now also becoming a pretty good branded generic piece for many of these companies. And then besides that, as I mentioned, that the CRO CDMO space looks very, very promising because of maybe Biosecure Act into the, I mean, globally into the US market, and then companies' inherent right to win. I mean, with the investment into the R&D, right sort of a talent set, right cost structure, and globally it is a very, very big market. So yes, I mean, I think some of these also do holds a lot of potential, and then obviously the consumer discretionary. So that any which way remains a very, very evergreen theme in the context of India market.
Right now, Ankit, moving on to both your funds, the Mirae Large and Midcap Fund and the Midcap Fund, both hold FSN E-Commerce and Delhivery, so which haven't really performed against the Midcap Index. So what's your current take on the e-commerce space, and especially given the recent underperformance?
So again, I mean, without going into individual stocks, I mean, if you look into, we have been very, very positive on some of these new age businesses, and some of them has performed. Yeah, maybe one of them has not performed onto the logistics side of it, and there are certain reasons behind that. But see, the common narrative or theme out here is that most of these businesses are market leader in their respective subsegment. That acts as a very, very strong entry barrier. Market leader in a, again, I mean, not a very, very fragmented market, right? Maybe in fact, in many cases, they are the market, right? I mean, so clearly, I mean, I think the business moat is pretty much being there, because with the scale being market leadership and all, inherently you do enjoy a lot of competitive advantage, as well as the as well as the cost, very right sort of a cost structure, or at times you are more than 100% of the sector profitability, or maybe sub-segment profitability. And plus on top of that, you are sitting on a pretty good sort of a balance sheet. So I think all of these acts as a very strong business entry barrier. At the same time, I think growth prospects, one should not even deviate given India sort of a construct. Many of these businesses do offer a very strong long run before the growth. So to that extent, I think it fits in perfectly in our investment framework of the business selection side of it. Second, on the management evaluation side of it and all, I mean, most of these businesses are again backed by a very strong, strong and passionate promoters or maybe entrepreneurs, and backed by again very strong board, corporate governance side of it, and very strong technocrat. In many of these cases, and they have seen. I think if that sort of a capability set might not have been there, they might not have been the leader at the first place in many of these segments. Yes. Now, tricky part comes out on to the valuation side of it, which is our third sort of a framework. So see, I think in many of these businesses, if you still try to look into their earnings and what estimates maybe people might have built it in earlier and now, there has been consistent upgrades, maybe except for one of the name which might not have performed well. But then there are some near-term challenges, right? Does that alter in any which way the business mode? Answer is clearly no. There might always be some sort of a challenges coming here and there, which might impair maybe earnings for next 1 or 2 quarters. But are you really, trying to play for that, or rather you are trying to focusing on to the how with each and every event the business mode is even getting strengthened, and that ultimately is going to translate into significant profit pool going forward. So that is how I said that in this current sort of a market where near-term earning outlook is getting a disproportionate benefit, and at the same time, I think near-term maybe earnings maybe being challenged or maybe might not be that great because of so many reasons. Those are getting disproportionately ignored in that sense, right? And that is not the right way to look at, as far as our sort of investment philosophy goes. So we do remain fairly comfortable across many of the newer businesses, despite of many of them doing well.
Now, Ankit, coming to the last question of this wonderful conversation, could you share with us what was your first investment into a stock? Which was the company? What was the outcome, and how long did you hold that stock?
First, it's really long time. Might be very difficult for me to recall as such, and it is all across the funds only, right? Because personally, any which way you are sort of a fully invested into the mutual fund, the funds which sort of you are managing. But yeah, I think because see, I do started into fund management from the Great Consumer Fund in October 2016. So yeah, I think there might be a lot of names as such. But in this process, yes, there might have been many winners, and at the same time, there are also a lot of omission. Quite a bit actually has been, unfortunately, in last 12 to 18 months. But yeah, I think that is how it is. So.
All right. Well, with that, it's time for us to wrap up this chat, Ankit. Thank you for joining in and taking the time for this interaction. Thank you.
Sure. No, thanks a lot. Thanks a lot for this conversation.
Thank you, Ankit.